A 2-week clock is about to hit zero, and it is holding 1/5 of the world's energy supply hostage. If the U.S. Iran ceasefire expires this Wednesday without a deal, we are not just looking at expensive gas, we are looking at a fundamental rewrite of the global economy. What does it mean to the market when a massive geopolitical deadline, a historic collapse in consumer confidence, and a $180 billion AI spending spree all collide in the same 72 hours? We have to start with the structural cracks appearing in the American economy. Let's look at the bearish stories threatening market stability right now. U.S. consumer sentiment has plunged to 47.6, which is an all-time record low for the University of Michigan survey. To put that in perspective, people feel worse today about their finances than they did during the 2008 Great Recession or even the depths of the 1980 energy crisis. Even though the unemployment rate is technically low at 4.3%, households are suffering from the twin shocks of lingering tariff impacts and a sudden 40% spike in domestic gasoline prices. Historically, when people feel this bad about their money, spending drops rapidly. Analysts are projecting that core retail sales for March will grow a meager 0.2%. Because of persistent inflation, a 0.2% nominal gain actually means real consumer demand is shrinking for the third consecutive month. If the consumer stops spending, corporate earnings across the retail and manufacturing sectors will face heavy downward revisions. Before we look at the energy crisis threatening your portfolio, if you want to stay ahead of these rapid market shifts, hit that subscribe button right now to join the Coffee Break Capital community. The most immediate systemic risk to the market is the scheduled expiration of the 2-week ceasefire between the United States and Iran on April 22nd. The Strait of Hormuz is a vital maritime choke point responsible for the transit of about 20% of the world's crude oil and natural gas supplies. Pakistan's diplomatic delegations are currently engaging in shuttle diplomacy across the Middle East to marshal support for a prolonged extension of the truce. If these talks fail and hostilities resume, the International Monetary Fund projects that oil prices could experience an 80% spike. This would push petroleum above $100 per barrel. This outcome would induce a profound stagflationary shock to the global economy, forcing the Federal Reserve to abandon any hopes of rate cuts. But the market is entirely divided right now. Let's pivot to the bullish stories, where the technology sector is operating with near total immunity to macroeconomic gravity. Alphabet's Google Cloud Next 2026 conference is kicking off in Las Vegas. The company is projecting a massive $180 billion in capital expenditures for the year, largely to fund AI infrastructure. Market sources suggest Google expects to ship an astonishing 50 million proprietary tensor processing units, or TPUs, by 2028. This confirms that enterprise AI spending is entering a multi-year supercycle. The massive capital deployment proves the AI hardware trade extends far beyond just NVIDIA's dominance, greatly benefiting semiconductor companies like Broadcom and Taiwan Semiconductor Manufacturing Company. TSMC actually just reported a 58% surge in profit, confirming the underlying resilience of AI chip demand. Sticking with the bullish tech narrative, keep a very close eye on Tesla. They report first quarter earnings this Wednesday. Wall Street already knows their vehicle deliveries fell 7% to 358,023 units. The real story is whether CEO Elon Musk can successfully pivot the narrative toward higher margin segments like the energy storage business and provide a concrete timeline for the highly anticipated robotaxi network. If he can prove the company is transitioning from a traditional automaker to an AI robotics firm, the stock could see a massive rebound. Finally, we are seeing incredible, gravity-defying strength overseas. Japan's benchmark Nikkei 225 stock average just reached a new all-time intraday high of 59,569. Driven by a structurally weak yen trading around 159 to the dollar, and immense foreign capital targeting semiconductor stocks, the historic 60,000 milestone is firmly within the market's crosshairs. So what are our predictions for the week ahead? The market remains highly vulnerable to binary outcomes. If the Middle East ceasefire is extended on Wednesday, expect a massive relief rally in consumer discretionary stocks and commercial airlines as energy costs drop. Conversely, if the talks fall apart, we predict a massive institutional rotation out of high beta technology stocks and into safe haven assets, defense contractors, and domestic energy producers. The safe takeaway here is to strictly prioritize balance sheet quality and defensive positioning until we get clarity on Wednesday's diplomatic deadlines. This information was compiled from various sources across the internet and is not intended as financial advice.